Hello, I'm Alex Davies, founder of Wealth Club, and I'm here today with Jonathan Moyes, our Head of Investment Research, to talk about the Wealth Club portfolio service, what's been happening over the last year, and his views for 2026. So, Jonathan, 2025 was an eventful year. Give us the headlines.
It was eventful. I guess sitting here today, we're recording this just before Christmas. So to the end of November, our 5 portfolios are up by between 6.6 and 12.4%. And really, it's been relatively calm for the past 6 months at least. So it felt like it had been a reasonably comfortable year. But actually, of course, when you look back at the start of 2025, it was really quite volatile. We entered the year and just an incredible amount of optimism in markets. There was interest rates were falling, inflation was falling. We had lots of cash-rich technology firms pledging to invest hundreds of billions of dollars into the real economy. Corporate earnings were in really good health, and we're on the cusp of a AI productivity boom. So it was hard not to feel optimistic at the start of the year. Fast forward just 2 months though, and all that optimism just evaporated. And the US administration came out with some pretty severe trade tariffs on pretty much the entire world. Even the penguins got a tariff. And that led to, I guess, just a complete evaporation of that optimism. Markets, the US stock market was down by a touch over 20% during that time, in about a 6-week period. US mid-caps, so the bellwether of the US economy, was down a little bit more, approaching 25%. So pretty severe falls in US stock markets to the start of April. And at that time, the mood music changed completely. It was January, it was one of incredible optimism. By late March, early April, it was almost a bidding war of pessimism. Every week we get sent economists' views of the future for 2025, and the forecasts for recessions just kept getting more and more severe. One economist would come out and say 80% chance of a US recession, another would say 85% chance. I think it got as high as 93% chance of recession. And of course, what happened? Well, stock markets rallied from that point on. Why did they rally? Well, the US administration clearly looked at what they had done, saw the market reaction and thought, well, maybe we should think twice about these tariffs. They extended the deadlines for countries to renegotiate trade deals. And there was one evening in April the 7th, it's about a 2-hour period where Donald Trump stood up on a podium and said, look, we're going to extend some of these deadlines, and the whole US stock market, biggest stock market in the world by far, rallied by 10% in about 2 hours. Actually, at home, I had an 18-month-old daughter at the time, and she learnt the word rally that evening. She was running around the house shouting rally, which is, good memories. I mean, that's kind of set the tone for the rest of the year. I think investors in general looked at that period and thought, well, clearly the market is still in control to some extent. And that's really reassuring. It means that lots of these politicians, they can't just impose their will on an economy. There are reactions to sort of keep them in check. And that's really summed up the rest of the year. We've gently rallied from that point on, and we sit here today, modest to good returns, I would say, across the board. We've managed to outperform, as of the end of November, our wealth manager peers, which is our target. So it's been at times volatile, but a pretty good year for our portfolios.
So what does this mean for investors?
I think the key takeaway for 2025, really I think it will go down as a case study in why we manage money the way we do. So we do 3 things. We build extremely well diversified portfolios. Now we haven't looked at all of them, but online, I would argue our portfolios are among the most diverse as you can find online. We don't take big macro views one way or the other. And we just fill our portfolios with lots of individual specialist active managers that are just focused on doing one particular thing. And we buy lots of them. And if you look back at 2025, there were just so many banana skins that you could have stepped on. You could have entered the year with too much optimism. Easy to do, given the macro backdrop at that point. You could have changed your view when the tariffs started to bite and markets were down 20%. You could have become incredibly pessimistic, and that would have also been a mistake. So I think avoiding the banana skins of 2025, that's the key takeaway, really. If you just stayed disciplined, you stayed diversified, you'd have done very well for yourself or for your investors. And then the key takeaway, really for the past 10 years, I'd say from 2015 to maybe 2024, stock markets and financial markets generally have been dominated by the US and the US stock market returns. And if you wanted to perform well, it was all about how much do you have invested in the US, how much do you have invested in technology. That changed in 2025. So it felt like markets were starting to go in search of a little bit more value. So Europe actually outperformed the US in 25. Who saw that coming? The UK outperformed the US, Japan outperformed the US. Infrastructure did incredibly well. So I think it just goes to show that, yeah, the real benefits of diversification, I think that's the key takeaway for us anyway in 2025.
You mentioned the UK market outperformed the US. So what effect will budget have on your portfolio?
Yeah, it's a good question. I think first and foremost, most important thing is we run globally diversified portfolios. So just as we don't spend too much time thinking about the French budget or the German budget, we don't spend too much time thinking about the UK budget either. The reality is it won't have much impact on a globally diversified portfolio either way. At the margins, it affects the value of sterling. It affects the cost of government borrowing to an extent. And it affects the fortunes of UK smaller companies. But it's in the context of a global portfolio, it's a small input, really. For UK businesses and for UK sentiment as a whole, clearly the outlook for the UK economy is bleak. But we'd caution against taking a view on the UK. It only needs to look a little bit less bleak. It can still be bleak, and you'd see markets rally quite strongly. So we'd be cautious of calling it either way, but it's clearly not a great time for the UK economy.
But for your portfolio overall, what's your outlook for 2026, and which areas do you think are going to do well?
Yeah, well, if we were forced to dust off our crystal balls, there'd be plenty of dust on them because we don't do this as a rule. We can have opinions, we just can't act on them. We must maintain a globally diversified portfolio. We must not take macro bets. We believe long term that's beneficial to our investors. But if we were to dust off that crystal ball, I think the search for value theme in 2025 was interesting. It's the first time we've seen it for a decade, investors going in search of cheaper parts of global stock markets. Can that theme continue in 2026? If it does, it will probably find its way into private markets. And that's where you can find much more value if you look. So real estate, for instance, private real estate has been on the floor for 5 years. Nobody has invested in real estate, which means not a lot of real estate has been built. And what we're seeing now is little green shoots. It seems like every week or at least every month, there's some big marquee corporate that's gone and taken a huge amount of office space. I think here in the UK, Visa just took a chunk of Canary Wharf. And you're starting to see companies change their working habits. More people are choosing not to work at home. So there's green shoots there for real estate. You can definitely see an environment where the asset class is cheap, demand is returning, and there's just no supply. So the conditions for strong performance for real estate, if you were gazing into that crystal ball, real estate is probably one of the areas we'd quite like. Private equity is the other. So you've seen global stock markets rally these past 3 years. A lot of that's valuations moving higher. Private equity hasn't had any of that. So the valuation gap between public equities and private equities has become quite wide. Corporate health is still pretty strong. We're starting to see green shoots of M&A come back, so the cost of borrowing is falling. Not just that interest rates are falling, but the spread differential, the cost for corporates to borrow over and above interest rates is also narrowing. So you're starting to see M&A come back, and that's the real driver of private equity returns. EQT wrote an interesting piece this past month talking about European M&A, and it seems like there's a real emphasis from regulators to start getting their industries to be more competitive and to start encouraging more M&A. And actually Europe had the best year in a decade for M&A last year, 2025 that is. So it feels like private equity, there's a few catalysts there that could help improve sentiment, and valuations are just much cheaper than global stock markets. So if we're gazing into that crystal ball, which we don't do, private real estate and private equity look most attractive to us.
Very interesting. Thanks very much.
So Alex, turning the tables, what's your outlook for 2026?
Well, Jonathan, I don't generally have an outlook. I generally do the same things. But I suppose firstly, I think probably, especially in the UK, people are being far too pessimistic. I suspect the economy will probably do a lot better than people think. Everyone's so miserable now, and I think there probably are green shoots. Even if we look at our own business, despite all the gloom, it's doing very well, and a lot of businesses are actually doing very well. In terms of what I do, I just keep doing what I always do. I'll make sure I put as much as I can into my children's pensions and ISAs. I'll do the same for my wife. I'll do the same for me. So I always invest mine and my wife's in your portfolio managed service because it's just really simple. I'll also do some VCTs, and if you are going to do VCTs, do them now because the tax relief's better today than it will be from April, and a lot of the good VCTs are selling out very quickly, so don't hang around. I'll also probably do some EIS and some SEIS. All this stuff's quite risky, but the tax relief's amazing, and generally over the long term you can do pretty well, and I have done pretty well out of it. So I'll keep doing all of those things, and over the last sort of year and a half I've been dipping my toes into investing in private markets funds, semi-liquid funds which are investing in later stage private equity owned businesses or infrastructure, etc. So I'll continue that theme. In summary, Jonathan, I don't know what's going to happen next year, nor does anyone else. So all I can do is invest each year, make sure I use all the tax shelters available to me, and diversify my portfolio.
Very good. Well, thanks so much, Alex.
Thank you, Jonathan.